How's it going, everyone? The concepts which I'm going to reveal will revolutionize your trading career. With the power of CRT, you'll unlock the ability to execute positions and swing trades with unmatched precision and confidence. Today, we are going to blend the internal and external range liquidity with CRT. Before we jump into today's session, I want to thank the MMXM Trader for introducing the powerful concept of internal and external range liquidity. Before we get into the main lecture, I will first explain the concepts of internal and external range liquidity. This will give beginners, or anyone unfamiliar with these concepts, can understand well, and they can easily follow the more advanced topics I will be covering later. The relationship between internal and external range liquidity and how they interact is the key to truly understanding where the market is likely to move. The knowledge you'll gain about these two types of liquidity is the foundation for developing the skills needed to anticipate price movements and predict where the market will likely draw next. Now, what are internal and external range liquidity? Internal range liquidity, IRL, is defined by fair value gaps, which are imbalances on your chart. External range liquidity, ERL, is defined by old highs and old lows. When external range liquidity is taken out, the next draw on liquidity often becomes a fair value gap. Similarly, when a fair value gap is filled, the next target becomes external range liquidity, such as an old high or old low. Understanding this dynamic is critical to predicting market movements. Now we have a basic schematic showing how to identify internal and external range liquidity. We start with this move up from here, and we have external range liquidity over here, which is an old low. As the price moves up and then down taking out that low, that's external range liquidity, because there's an old low down here. Price basically does two things. It goes to old highs and lows, or seeks to reprice into imbalances. In this range where we move lower from, there was a fair value gap or imbalance higher up. Once price took out the external range liquidity, the next thing it will do is move to internal range liquidity, which is that fair value gap. So, think about that. When you see an old high or low get taken out, you want to look for an imbalance within that range to get repriced. Once that gets hit, we can then aim for the next target, which is another external range. Same idea here, but in reverse. We have external range liquidity at this old high. Price moves lower, forms a swing low, and then moves up, taking out that external range liquidity. While taking out the external range, or old high, an imbalance is formed down here, which could be a fair value gap. After taking out the external range liquidity, price moves back into the fair value gap. Once it hits that internal range, we then look to target the next external range again. As explained earlier, price only does two things. It draws to old highs and old lows, and it rebalances an imbalance. There's literally nothing else price does. With that in mind, it becomes very clear, after you see old highs or old lows getting rated, what are we going to look for next, right? We're going to look for an imbalance where we can trade into. Let's say we are in a bearish order flow, and we take out an old low. There's probably a fair value gap at a premium level in that same structure that we can look to trade and buy into. After that old low has been rated, we can buy into that fair value gap. Once that fair value gap hits and respects it, we can look for external range liquidity again, right? Now we are moving towards our main topic. We are going to blend the internal and external liquidity with CRT. By blending the IRL and ERL with CRT, not only will increases our winning ratio, but we can also greatly enhance our risk to reward. Let's assume our CRT forms within the IRL, like a fair value gap. In that case, we can confidently target the CRT high-low and hold our trades to the next old high-low, which will act as the ERL. Now, before we dive into live chart examples, let's first look at a schematic depiction of this concept. Whenever the market reaches the ERL, it creates a CRT before moving toward the IRL. Similarly, when the market moves from IRL to ERL, it forms a CRT within the imbalance, which becomes the driving force behind the entire move. By understanding and following these concepts, not only can you target the opposite end of the CRT, but you can also hold your trades up to the next IRL or ERL, potentially increasing your risk-to-reward ratio. In this schematic, you can see how price filled the imbalance and created a CRT before pushing toward the ERL, which became the catalyst for the entire move. Same here. after taking out the ERL, which was an old high, the market created a CRT before rebalancing the imbalance and moved toward the next draw on liquidity. Once again, after reaching the ERL, a CRT was created, leading the market toward the IRL FVG, and yet again, another CRT was formed before targeting the next opposing liquidity, which in this case is our next ERL. And you can see same thing happen on the reverse side. So, without wasting any time, let's dive straight into some live examples. We're on the 4-hour chart of EUR USD. Pause the video for a moment and reflect on the concepts I just taught you. As you can see, the price has recently taken the ERL and started moving upward. But did you notice something crucial? Right before this upward move, the price formed a CRT, which was the driving force behind the entire move. Now, the market structure has shifted to the bullish side. Since the price has taken the ERL, our immediate focus should shift to the imbalance and the fair value gap, FVG. Let's mark that FVG. Can you see what's happening? Exactly as before, the price created another CRT right before heading to the next ERL, which was an old high. Again, within this IRL, the CRT formed and drove the entire price leg. Now, if we enter a long position from here, not only can we target the high of the CRT, but we can hold our trades all the way to the next ERL, which is the old high. This way, we significantly boost our risk-to-reward ratio. Moving further, once again, as soon as the price took the ERL, it formed another CRT before targeting the imbalance IRL. Then, the price moved toward the IRL target, and again, within this IRL, an FVG, a CRT was created, driving the entire move. Our first target should be the opposing end of the CRT, and from there, we can hold our trades up to the next ERL, which is the old high. As you can see, by combining IRL and ERL with CRT, we can catch market turning points that are often the cause of reversals, retracements, or continuations. Believe me, guys, I've backtested this extensively, and it works wonders. Look closely at this example, and you'll notice how the price consistently creates a CRT before moving from one liquidity point to another. Let's move on to a top-down analysis to see how these concepts work in a live market and how you can incorporate them into your trading style. In our first example, we're looking at the 4-hour chart of AUD-USD. You can see that the price recently took out the ERL and then rebalanced the imbalance, which is our IRL. Let's see what happens next. The price continues to move upward, and right here, it takes out the ERL again, closing inside the previous candle, forming what could be our CRT, which is likely to drive the price lower toward our IRL, that FVG. Now let's mark the high and low of the CRT range. Next, we switch to a lower time frame, in this case, the 15-minute chart. We use the 15-minute because we identified the CRT on the 4-hour chart. Now that we're on the 15-minute time frame, the CRT ranges are highlighted with red dotted lines. Let's see what happens next. You can see that the price has created a turtle soup pattern and a change of state displacement, CSD, forming a high probability order block. We mark this order block and open our short position here, placing our stop loss just above the swing high. Our first target will be the low of the CRT range, and the final target will be the IRL, which is the FVG. Let's see how it plays out. You can see the price is moving downward, and we've hit our first target. Now we'll extend our target to the next IRL. Let's watch what the price does next. And finally, you can see that the price has hit our final target, which is the IRL FVG. Notice how the higher time frame showed displacement to the downside, perfectly aligning with our target. Let's continue from where we left off. You can notice that the price has tagged the IRL, and once again, we see a CRT forming here, which could serve as the driving force for the price to move toward the next ERL. Let's mark the high and low of the CRT range, which I've highlighted with green dotted lines. We'll also mark our next ERL, which is this old high. Now let's switch to the 15-minute chart. As you can see, when the price tapped into the IRL on the 4-hour chart, it formed a CRT, and on the 15-minute chart, we had a change in the state of delivery, CSD. We'll mark this and open our long position here, with our stop placed just below the swing low. Our first target will be the opposing end of the CRT, and the final target will be the next ERL, which is the old high. Let's see how it plays out. And we've hit our first target. Now, we'll extend our target to the next opposing liquidity, which is the next ERL. Let's see what happens next. You can see that after the price made an upward move, there was some accumulation, and finally, the price hit our target. If you look at the higher time frame, you can clearly see how the market moved from ERL to IRL, and then from IRL to ERL, creating a CRT before each move, which ultimately led to hitting our final target. Now let's move on to our final example with the Nasdaq E-mini futures on the 4-hour chart. The price is moving within a range, but is overall in a bearish trend, so we'll mark the ERL. Let's see what happens next. As you can see, the price has taken out the ERL and then rejected it. We'll wait here to see if a CRT forms. If it does, we'll look to enter. Let's see how this plays out. You can see that the price swept the low of the previous candle and closed inside, which indicates that the next 3 candles could form a CRT. So, we'll mark the CRT ranges and also identify our next liquidity, which is the IRL, right here in this FVG. Now, let's switch to the 15-minute chart to see how it plays out. We're on the 15-minute chart now, and our CRT ranges and IRL, which will be our final target, are marked. Let's see how this unfolds. The price shows displacement to the upside and creates a change of state delivery, CSD, which we'll mark. There's also a breaker above that we should note. From this point, we can open a long position, placing our stop just below the breaker and the FVG. Our first target will be the high of the CRT, and the final target will be the IRL, which is this FVG. As you can see, our first take profit has been hit, so we'll extend our target to the next liquidity at the IRL and see how the price reacts. And you can see that the price finally reached our target. Additionally, if you look at the higher time frame, you'll notice how the price moved from ERL to IRL by consistently creating high probability CRTs. Once again, we're expecting prices to move from the IRL to the ERL, and the market has already created a CRT. Let's mark its high and low, as well as the next ERL. Now, we'll switch to a lower time frame and see how it plays out. All our levels are marked here, so let's observe the movement. You can see that the price has recently executed a change of state delivery, CSD, and created a high probability order block, which we'll mark. From here, we can open our short position, targeting the CRT low, with our final target set at the next ERL, which is this old low. Let's see what happens next. The price has retraced back to the order block, so let's continue to follow along. The price has moved down and retraced again, creating another turtle soup. Let's see how this plays out. Notice how quickly the price moves to the downside and hits our first target. Now, we'll extend our target to our next opposing liquidity, which is the ERL, this old low. Let's see what happens next. And there you have it. The price has hit our final target, offering a significantly high risk-to-reward ratio. You've probably noticed how blending IRL and ERL with CRT allows us to catch swing trades with remarkable precision, effectively increasing our rewards while minimizing risk. Believe me, this method works exceptionally well, so go ahead and backtest and forward test on your charts. For more content and trading insights, make sure to subscribe. If you'd like to join my Telegram community, the link is in the bio. Good luck, traders, and I'll see you in the next one.